It's Friday, October 24th, 2025. Welcome to your news update on Blip Brief, small but almost everything updated every weekday. Okay, let's dive straight in. The Indian market. Oh, it clocked its sixth straight day of gains yesterday. But honestly, if you were watching, it felt less like a smooth climb and more, I don't know, volatile.
Absolutely. The final numbers, Sensex up maybe 0.2%, Nifty 50 up 0.1%. They really don't tell the full story, do they?
Not at all. So what was really going on underneath?
Well, the initial spark, the big jump early on, that was all about optimism. Specifically, reports that the India-U.S. trade deal might actually be moving forward.
The trade deal. That's been talked about for ages. What's the potential change?
The talk is potentially lowering those tariffs, maybe from that high 50% level down to something like 15 or 16%. I mean, that's a potential game changer for exporters.
Okay, yeah, that would definitely fuel some confidence. But you mentioned volatility. That early surge didn't last.
Not even close. We saw some really aggressive profit booking kick in later, wiped out, hundreds of points off the Sensex gain, and maybe 400 points from the Nifty's high for the day.
Wow. So a real tug of war then.
Yep.
Long-term hope versus maybe short-term nerves about, well, everything else going on globally.
Precisely. It shows you a market that's kind of split, isn't it? You've got traders quick to lock in profits, maybe not fully trusting the rally yet, but underneath, there's definitely interest in sectors that would really benefit if that U.S. tariff cut happens.
And we saw that play out, right? IT stocks, textile stocks, they were clearly leading the charge.
Yeah, absolutely. The market was pricing in that potential relief. You saw big IT names, Infosys up between, say, plus 3.8% and plus 3.9%.
HCL Tech also strong.
HCL Tech climbed, between plus 2.4% and plus 2.6%, and TCS added about plus 2.2%. It's like the market's placing a big bet that this trade deal is not just talk this time.
A compelling story, that export hope. But let's contrast that with the domestic picture. Corporate earnings paint a slightly different scene, don't they?
They certainly provide a reality check. Take Colgate-Palmolive. Their net profit actually dropped 17% year on year. Revenue down about 6.3% too.
17%? This is a steep fall for a household name like Colgate. What happened there?
It seems to be a direct hit from the GST rate change on their oral care products. It just shows how policy tweaks can immediately bite into profitability, especially in, such a price-sensitive market.
Right. They either have to absorb it or risk losing customers if they raise prices.
Exactly. But then you look at Hindustan Unilever, HUL, and they're sounding much more upbeat, talking about a stronger second half for FY26.
Okay, so how does that work? HUL's optimistic while Colgate's feeling the pinch. What's HUL banking on?
Well, they seem to be counting on a few things coming together. One, commodity prices staying relatively low, which helps their costs.
Okay.
Two, food inflation easing off, which hopefully gives consumers a bit more spending power. And three, just a general sense that demand will pick up later in the year.
But hold on. We're about to get into some pretty serious geopolitical stuff, especially around oil. If energy costs spike, doesn't that make the benign commodity prices assumption look a bit shaky?
That's the risk, isn't it? HUL's outlook really depends on a level of global stability that feels quite fragile right now. They're basically betting that domestic demand will be strong enough to offset potential external shocks. It's a calculated gamble.
Speaking of risk, or maybe appetite for it, the IPO market seems completely unfazed. The buzz is just relentless.
It really is. Rubicon Research listed, a 28% premium? That's strong. And Canara HSBC Life Insurance also jumped about 5% on day one.
And that Midwest IPO, the GMP, the gray market premium, jumped 14% even before it listed today, right? Explain the GMP for us again.
Sure. The gray market premium is basically an indicator of unofficial demand before the share even start trading officially. A high GMP, like that 14% jump, suggests there's huge interest, often from retail investors hoping for quick listing gains.
So it's interesting. You've got cautious profit-taking in the big established stocks, driving that intraday volatility we talked about. But then you have retail investors seemingly piling into IPOs, chasing those high GMPs. Are these just two different worlds operating side by side?
In a way, yes. They're driven by different things. The institutional money might be more sensitive to the global macro picture, the geopolitical risks.
Right.
Retail investors may be more focused on the domestic story, the narrative, the potential for quick returns. It does suggest that domestic liquidity, at least at the retail level, is still pretty strong, even if the bigger players are a bit more cautious.
Okay, let's shift gears then. to those global shockwaves you mentioned. Energy is front and center, with new U.S. sanctions hitting Russia's big oil companies.
Yes, this is a major development. Sanctions on Rosneft and Lukoil, and the ripple effects started almost immediately.
How so?
We saw Chinese state-owned oil companies quickly suspend buying Russian oil that comes by sea. And crucially for us here in India, our own refiners are now apparently getting ready to significantly cut back on Russian imports too.
Wow. India became quite reliant on that discounted Russian crude recently, didn't it? It was like our biggest single source for a while.
Yeah.
Cutting back must come at a cost.
A significant cost is the estimate. We're potentially looking at a hit of around, well, billions in dollar terms. And big players like Reliance Industries could see a noticeable impact on their earnings, their EBITDA.
So it forces a rapid search for alternatives, which are probably more expensive.
That's the likely outcome. It raises bigger questions, too, about how much our energy strategy is influenced by, U.S. foreign policy decisions. It definitely constrains the ability to source the cheapest inputs.
And you see that tension playing out in the oil price itself. It dipped a bit, but is still set for a weekly gain.
Exactly. The dip might just be noise. The underlying story is this push and pull. On one side, you have supply fears because of these sanctions. That adds a risk premium.
Okay. On the other side, tempering that fear, you have the fact that OPEC has spare capacity it could potentially release, and maybe some hope pinned on upcoming U.S.-China trade talks, easing broader tensions.
Makes sense. And with all that tension, investors look for safety, right? Gold prices firmed up.
They did, up about plus 1.4% yesterday. Yeah. That's your classic flight to safety move. You've got the geopolitical worries, the ongoing U.S.-China friction. It all pushes investors towards perceived safe havens like gold.
Plus, people are waiting for U.S. inflation data.
Yes, that's key. Everyone's watching for clues about what the Federal Reserve might do with interest rates. The market's definitely anticipating some kind of move there in the coming weeks.
Okay, bringing it back home to the money markets. The rupee actually strengthened a tiny bit against the dollar yesterday.
Yeah, marginally. That was probably just riding the coattails of the positive mood in stocks, that risk-on feeling tied to the trade deal hopes we discussed.
But that's maybe a bit superficial, because underneath there's a liquidity issue brewing. That's right. The banking system's liquidity actually turned negative, went into deficit for the first time in about a month.
Negative liquidity. So banks are short on ready funds. What's draining the cash?
Two main things, it seems. First, the RBI, the Reserve Bank of India, has been intervening in the currency market, selling dollars, which effectively pulls rupees out of the system.
Okay, that's a policy tool.
And second, it's also the festive season effect. People withdraw more physical cash for spending during festivals, and that cash leaves the banking system temporarily, reducing overall liquidity.
And that shortage shows up in how companies are borrowing. We saw a big jump in commercial paper issuance.
A huge jump. CT issuance value was up 44% in September.
44%?
Yeah. And remember, this is short-term debt, so companies are leaning heavily on it for immediate needs.
Even though the cost of borrowing, the yields are actually going up.
Exactly. That tells you something. It suggests companies really need that working capital now. They're willing to pay more for quick access to funds, which could mean they're managing tight cash flows or maybe funding inventory buildup. It's definitely something to watch, that reliance on expensive short-term debt.
Okay, let's step onto the wider global stage. Trade tensions flaring up again, this time between the U.S. and Canada.
Yes, and over a really unusual trigger. President Trump apparently terminated all trade talks with Canada.
All talks. Why?
It seems it was directly linked to some Canadian TV ads that were protesting U.S. tariffs. The president reportedly called them egregious and an attempt to influence U.S. courts.
Wait, seriously? A TV ad campaign derailed major international trade negotiations. That seems incredibly fragile.
It really underscores how politics, sometimes seemingly minor political reactions, can just abruptly change the course of global trade, maybe overriding the economic logic.
And that kind of unpredictable environment is exactly what the IMF is warning Asia about, isn't it?
It is. The IMF's message to Asian countries is basically, you need to strengthen yourselves from within, cut the trade barriers between yourselves, boost regional integration.
Why? As a defense mechanism?
Pretty much. To build resilience against external shocks, like new tariffs or sudden policy shifts from the U.S. or elsewhere. The thinking is, if Asia trades more amongst itself, it's less vulnerable.
Does the IMF still see growth for Asia despite these risks?
Yes, they're still projecting decent expansion, around 4.5% for 2025, but it hinges on building that internal resilience.
And quickly, One more international item, the EU and Ukraine, concerning those frozen Russian assets.
Right, this is a very sensitive one. EU leaders are cautiously moving towards using the proceeds from frozen Russian central bank assets to fund a large loan for Ukraine.
Using frozen assets, that sounds legally complicated.
Immensely complicated, both legally and politically. Seizing sovereign assets is almost unprecedented. It's vital support for Ukraine, obviously, but it sets a potentially powerful, though maybe shaky, precedent for future conflicts. They're treading very carefully.
Okay, let's end, as always, with a look at innovation. And today, it sounds like something potentially transformative in material science. A new superalloy.
Yes, this sounds genuinely exciting. Scientists have developed a new alloy. It's a mix of chromium, molybdenum, and silicon.
Okay, what makes it super?
Its properties. The reports say it essentially refuses to melt even under extreme heat. But crucially, it also stays ductile, meaning it doesn't become brittle, it can still be shaped, and it resists oxidation or rusting.
That combination sounds useful. Why is it a potential breakthrough compared to what we use now?
Well, think about things like jet engines or power turbines. The current best materials, usually nickel-based superalloys, they have a temperature limit. They start to break down around, say, 1100 degrees Celsius.
Right.
That temperature ceiling limits how efficiently those engines or turbines can run. You can only run them so hot.
So this new alloy pushes that ceiling much higher.
Potentially, yes. Significantly higher. If you can run engines hotter, they become much more fuel efficient, produce fewer emissions. It could open doors for next-gen power generation, maybe even things like hypersonic flight. The material itself has often been the bottleneck.
And this could potentially unblock it.
That's the hope. It could really change the game in several industries.
Fascinating. It really brings together everything we've discussed. Market nerves, geopolitical pressures, and then suddenly a potential leap forward driven purely by science. Maybe the future isn't just about trade deals, but about who masters the next generation of materials. A powerful thought indeed. And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.